Good afternoon, everybody. Thank you all for gathering here today. My name is Casper Spokus. I'm the Director of Insights and Integration Strategy here at Clean Air Task Force. I'm going to be opening up this session today with some introductory remarks, and then we're going to pass it over to our distinguished panel for hopefully what will be a very interesting conversation. Okay. So, the barriers to financing global decarbonization can be thought of at several different levels. At the top level, at the global macro level, generally, additional trillions of dollars that are necessary to fund global decarbonization by mid-century are often assumed to be readily available. In reality, however, when you look at capital markets, most of capital is provided by institutional, risk-averse investors who are looking for blue chip investments. And thus, whether it's risk tolerance or regulatory oversight, the overall supply of capital that is available for energy sector investments is currently much smaller than what is necessary. Climate policies around the world are also seen as changeable, some more so than others, depending on the region. And that reduces the quality of the investments for these institutions, and thus either increases capital costs or prevents investments from going forward. Generally, when you look at overall academia and policymakers, we also don't have a good understanding of the impact of climate actions with regard to shifting investment into the energy sector on overall macroeconomics going forward. So we see this as quite a big gap in our understanding. Going to that middle layer cake level, major barriers exist to flowing capital from one region to another or into specific countries. And these come from a variety of factors and risks related to the policy certainty, overall off-taker risks, and others. That often materializes in capital costs or costs of capital that are 2 to 3 times that of OECD rates. And those costs can become very significant barriers for attracting institutional capital. Unfortunately, the solutions that are often discussed in this space, such as concessionary finance or mechanisms to hedge currency risks, while in the right direction, are unlikely to scale to at least the amounts that are necessary to finance global decarbonization. And then on the lower level here on this graph, the amount of high-risk development capital necessary to build these large infrastructure projects to get them to the point where banks can come in and provide the final investment decision remains underappreciated in terms of the challenge. And the overall process of capital discipline may present speed limits as we try to decarbonize the energy sector as quickly as possible. So as you can see, we have quite a full plate of issues to discuss on your panel. Next slide, if possible. Great, thanks. So just to provide a little bit of a reference frame using some numbers. On the left here, we provide annual investment into different types of sectors or categories. Today, we invest about $1.8 trillion a year in clean energy investments globally. That rises to about 2.8 when we consider all energy investments globally. In comparison, we need to reach around $4.5 to $5 trillion a year by 2030, according to the IEA, for investments going into the energy sector as a whole. Just for a rough comparison, that gap is roughly equal to global spending on military and defense today. On the right-hand side, we provide a little bit of a different comparison, where we show that the amount of investment that is additional investment that's needed in the energy sector is roughly a quarter of the amount of investment in new things today, as measured by gross capital formation minus capital consumption. So we need a lot of shifting of capital from other sectors into the energy sector at a rapid pace if we want to decarbonize. Unfortunately, there remains significant gaps in our understanding of how we can make this possible. Global climate models and the models that try to estimate how much capital needs are presented by this shift don't do a very good job or aren't fit for purpose for evaluating whether that shift can actually occur. For the most part, they have one global cost of capital that is flat across the country. They generally force decarbonization with very high carbon prices. And those prices in the models themselves result in significant shifts in allocation of capital from sectors that we are investing in today, and can also result in demand destruction. When we look a little bit further into these models as well, generally they were never made to look at these questions, and so as a result, they've never included representations of capital markets or any sort of monetary policy feedbacks. The overall availability of capital is also not modeled, and as a result, these models have not done the job of evaluating long-term impacts on the global economy and the macroeconomy of this transition. And that represents a significant gap in our understanding. Looking at emerging and developing economies, the challenge is even greater, unfortunately. The IEA estimates that we need about a quadrupling of capital to flow into emerging and developing economies, excluding China, by 2030, and another doubling by 2050. Currently, when we look at the investment situation, cost of capital rates are roughly 2 to 3 times that of OECD rates. And again, as I mentioned earlier, the current mechanisms that are most popular are unlikely to provide the scale necessary. On the graph here, we also provide the pledged amount of financing for emerging and developing economies, and you can see that it's quite a small number in comparison. And so when we think about how to achieve this, we need to go beyond current mechanisms and start thinking about new strategies to enable this amount of investment to go in, and overall reforms that will be necessary to also improve local domestic capital markets and grow wealth locally so they can fund the transition. So this last slide is what I'm leaving you with, which are questions for the panel to dig into. I'm not going to dig into these right now, but I just want to end by saying, when the dust settles at COP28, we all think that it is time for the community of educators, academics, policymakers, and practitioners to start appreciating that we have a lot of gaps in our understanding when it comes to this topic, and that we collectively work together to try to achieve some creative solutions. So with that, I'm going to introduce the panel today. Moderating the panel is Kurt Waltzer, Senior Advisor at Clean Air Task Force. And our panelists are Jeff Brown, Managing Director of the Energy Futures Finance Forum, Wally Shonibare, the Director of Energy Financial Solutions Policy and Regulation at African Development Bank, Chris Gregg, Senior Research Scientist at Princeton University, and Vamsi Allah, Executive Director in Corporate Finance Advisory at JP Morgan Center for Carbon Transition. And unfortunately, Mekhala Krishnan from the McKinsey Global Institute was planning on joining but couldn't today. So Kurt, I'll pass it over to you.
Thank you, Kat. Thank you, Kaspers. We've asked our distinguished panel to really treat this as a conversation. So we're going to talk about this by exploring this through all the layers of the layer cake that Kaspers talked about. The macroeconomic questions and perspectives, how this really plays out in emerging markets and developing economies, and then at the project level, what do we really need to be thinking about in terms of capital discipline? So let's just go on to the first topic. And when we're looking at the question of global financial markets and macroeconomic questions that we need to be thinking about, some questions I'd like to kick off with our panelists are, how big of a lift is this really? If we're looking at $2 trillion, or some estimates put this at $5 trillion, is this the kind of money that's lying around on balance sheets and in zero interest accounts, not really accruing funding? Is it just waiting for the right projects to come along? And what kind of conditions are needed to really drive this level of investment at this scale? So, Jeff, I'm actually going to turn to you and have you kick us off this discussion because you have an interesting perspective. You're currently leading a project for EFI that's focusing on policy resilience and how the importance of that in policy design rather than moving capital markets. But before that, you spent several decades working on the trading floor for investment banks. So you've got both hats, and it would be good to hear from your perspective. Is this a big number? Is 2 trillion a big number? Is 5 trillion a big number? And what does it require? What is required to move that kind of capital?
Thanks, Kurt. And, actually, an extra couple of trillion is not chump change in the global economy for financing. And, this is, if you're an investment banker and you're in, say, capital markets, you kind of watch the flows of money very carefully. Like farmers watch how the crops are growing, right? You're really watching the flows of money. 2 trillion is big. Like, in the context of how the annual new money that goes into all the institutional managed pots of funds in the world, mutual funds, insurance companies, pension funds, sovereign wealth funds, has been running about 2.5 trillion a year. So just the increment we are talking about, just for clean energy financing, is about equal to all of it. Right, there's other sources of money, but let's put this in perspective. Or just to look at the U.S. economy, right, which is about a quarter of the world. Total new money raised for corporates and put into new fixed capital investments has been running around 300 billion a year. That's for everything that the private sector owns in terms of fixed assets. So yeah, a couple of spare trillion in that context is a really big amount of money. Doesn't mean it's not doable, right? What it means is the quality, and this is something that, Vamsi can attest to, it's just the quality of the projects offered to investors has to be impeccable. And the problem is, it's not impeccable very often, right? It's, externality is decarbonization. You're trying to deal with pollution, and you depend pretty heavily on government policies. And unless the government policies are absolutely blue chip, good as gold, rock solid, makes it very hard to tap money in this volume. There is money, but it has to be low risk before we can get the volumes done. That's what scares me.
Yep. Yeah, happy to build on that. So let me put some of these numbers in context based on some analysis we did. So if you, a lot of publications starting from McKinsey, Bloomberg, and others have spoken about around $4 to $6 trillion annual investment needed to get to net zero, right? Again, once you get past the billions, like what's a 4, what's a 10, what's a 15 trillion, right? So I don't think you can count that many zeros. But one thing we can sort of normalize it by is the amount of investment the corporate world is making, right? Like, so when we normalized it by, we took all the global large and mid cap companies and then looked at their capital expenditures. So if you take that number and multiply it with 2.5, then you get the 5 trillion. If you take the same set of companies and look at the free cash flow they are generating in a given year, you take that number and you multiply it by 2, you get to 5 trillion, right? So this global investment that is needed is significant. A multiple, I guess, like almost double of like how much the current investment that's happening from the corporates. And I don't think we've seen any similar transition of this magnitude or scale for context. So that's one. The second thing I would look at is, to Jeff's point, yes, there's always money. There's whatever, like the assets under management of 100 trillion globally, right? But in the finance world, you always think about what is the objective of that money, what is the return expectation of the money, and what is the risk that money wants to take, right? So I'm sure a lot of that 100 trillion that is managed is owned by the pension funds and life insurance companies, or somebody like investing in a more like fixed deposit kind of instrument, which is not the money that is going to go target a new development in an emerging economy, right? So I think it's important for us to think about the quantum of capital, but also like what is the risk return profile that capital is seeking. My sort of like broader thought process on this is, I mean, to make something of this scale happen, you just need the appropriate risk return characteristics and an appropriate like asset class that can take this money and sort of like approach it. And again, as we continue the conversation, I'm sure we can peel the layers of what is needed for established technologies, what kind of capital is needed for newer technologies that are going to decarbonize, and then go from there.
For appropriate risk return, that's like banker speak for it better be pretty darn profitable, and there better be bloody tiny risk you're going to lose your money. That's quote, appropriate risk return. It's not, I'm willing to take a rotten return and I don't mind it if I lose my money.
Yeah, I mean, one of the obviously we spend a lot of time with investors on these topics. One thing we hear is when they're evaluating certain transition-related projects in the U.S. and emerging economies, what's happening right now is they're probably seeing similar return profiles, like similar return profiles of the projects, but clearly the risks are different, right? So they need to be able to account for the foreign currency risk, they need to be able to account for political risk, and all of those. So once you adjust for that risk, then the return expectation is low, and thereby a lot of what we're hearing is, okay, we're going to deploy, given the chance, we're going to deploy in the developed world, right? So I think there's a lot to unpack in terms of like how do you get that risk-adjusted return to an appropriate level, because let's be very honest, it's not, I don't think it just people deploying capital out of the good of their heart is going to mobilize $2-3 trillion a year, right? It's not, philanthropy is not going to get you, you need to be able to like get the real money that is going to look at market risk-adjusted returns, and for that to be incentivized appropriately to actually like deploy or mobilize this capital.
Let me build on that a little bit. So what you've been talking about is that there's some capital where those investors, their objective is primarily to keep that capital safe. They are happy with low returns. They want almost no risk. And then there's another segment of capital that is happy to invest in things like factories and other types of investments. And that's a much smaller level of capital. So if we're trying to reach 2 trillion or 5 trillion a year, that doesn't exist, then that means we have to make those investors who want almost no risk move their money over to the kind of investments they wouldn't take even if they were traditional energy investments. So how do we do that? What are the mechanisms that are needed to move that capital into where it could be put to use and deployed? And how much does that cost? It's going to cost something to de-risk that. So what kind of scale are we talking about? What has to happen? And how definitive do those policies need to be? In other words, how important is it to make sure that investors believe those policies are going to be supported by policymakers today and 5 years from now and 10 years from now?
Kurt, can I jump in there? So maybe an easy way to say it is, what do all the models that policymakers look at, and that when you read an IPCC assessment report and you see, well, these models are all converging and maybe we can make 2 degrees C. What's generally assumed in these models is very different than the real world. What's assumed is governments will put in place carbon taxes at a level, like $100 a ton, and they're going to increase. They never go back down. Once they're put in place, you don't have what Australia had, which is, oh, we're going to get rid of our carbon tax. Right. They are not gotten rid of. They are rock solid, and investors act as though they are 100% certain that these government policies won't change. That's how the models get to their nice solutions. The IMF analyzed it and said, what if investors are a bit worried that they don't want to spend $500 million on a capital project that depends upon the rules staying nice and solid? And they said, it costs a lot more money, and it hurts GDP, and it hurts labor, and it hurts inflation if policies as to carbon are not rock solid. And they kind of go from their background of looking at anti-inflationary policies, which have to be rock solid or else they're not very effective. So if you say, what has to change? Policymakers in countries such as the US cannot be complacent. They can't say, yeah, our policies seem pretty good. Investors are used to taking risk. You know, there's lots of, right. The real investors do not take risk. They do not roll the dice. They don't play Russian roulette. And they demand policy stability. And that's the thing that I worry about, Kurt, is the false complacency on the part of policymakers that, we can change our mind and do something different next year. That is not what markets like.
Well, I think we're probably going to be talking about modeling quite a bit, because models are sort of the coin of the realm in talking about climate change. And there's been one observation that all models are wrong and some are useful. But the question of the modeled world showing everything happening perfectly versus how the markets really evolve and develop, I think, is crucial. And I want to explore the point you just raised, Jeff, about some of these models really aren't looking at these macroeconomic questions. So if, for example, all new global investment today is about $8 trillion, and we have to add $2 or more trillion to the energy sector, that means that's either going to come from that $8 trillion, or the investment as a whole is going to have to grow at levels that are, sort of unprecedented. So what are the macroeconomic questions or implications of moving that kind of capital? We saw from one of the slides that Casper showed that services, for example, saw a significant drop in investment versus energy, which saw a relatively more modest increase in investment. That means that there are sectors of the economy that are going to be getting less investment. Should we care about that? Does that matter? Is that going to have some implications that we should be thinking about?
Yeah, I'm happy to take it. So, as you think about all the energy transition related investments, right? So, one thing to keep in mind broadly is most of the fossil infrastructure is you have an amount of capital expenditure you need to put in at the beginning, but you also need to spend a lot on operating that asset over time, right? Whereas a lot of energy transition related policies tend to be you expend a lot of money at the beginning, and then the operating expenses tend to be sort of lower. The reason I bring that point up is we were talking about macroeconomic issues, right? And in the last year when the interest rates went up, again, I'm sure many of you have followed, last year wasn't particularly good for any green companies in the market. In fact, a lot of energy transition related companies have performed really poorly, owing to a lot of these macroeconomic factors. So what I'm trying to say is this energy transition is going to be very sensitive to the level of interest rates, because you need all the capital upfront, And if the interest rates are high, that's going to impact these investments much higher than the other investments. So that's one thing to keep in mind. A related point I would think is inflationary effect of these investments, right? So if you think of it, again, if all the governments and private sector is deploying all this capital at once, then it should, from an economics perspective, lead to inflation. But then the point on operating expenses being lower, so the cost should reduce in the back end, so that it normalizes like over time. Look, I don't like seeing this on the ground. I don't expect this transition to be linear. We'll have lots of ups and downs and lots of challenges. But one thing I truly sort of like believe is the secular tailwinds are there, right? Like especially like if you think of US, we were talking about policy. I will say like the Inflation Reduction Act and the bunch of climate provisions in the infrastructure law. Those are like some of the biggest investments any government had made in climate, right? And again, I don't know if this was by choice or by accident. I think it was by choice. A lot of the investments that came out of IRA actually like went into the red states, right? So as some of those projects are getting built, it becomes like difficult. There's going to be a lot of like hopefully grassroots support in the regions because of the jobs that are created. And that is one way, like one example I'm saying on creating that kind of like policy certainty. It's not going to be the same kind of polarization potentially in other regions of the world. Maybe the needs are different. In certain regions, they have to think about energy security, and maybe there's some angles that creates that level of consistency like over a period of time. But it's essential for private sector finance to like flow, that policy certainty to exist. Because if you think of a lot of these energy transition investments, they're financed by what we would call project finance, right? So you need to say that I'm going to build this asset, I'm going to structure the cash flows that come out of that project, and find a project finance dedicated to that. The alternative is corporate finance, which is I'm going to finance the company that is building this, but then the company needs to have a stronger position to be able to raise capital there, right? But these project finance loans are typically like 7-10 years like cash flows, and you need to be able to structure that and raise capital. And if you're building a hydrogen plant and you know that I'm going to get $3 per kilogram subsidy, the investor needs to have certainty that they will get that over the course of the 7 years for which the bond is being raised, right? So it's very essential to think about, for governments and policymakers to think about what are the sort of indirect things they can include in the policies that will make it stick like for longer than just their term of the administration.
And I just want to build on what Vamsi.
Can I bring this down to actual project level? What happens? Because there are different levels of this conversation. So we can talk about models or macro, but in emerging markets, what we see is that first of all, energy access is far more important than the transition. Like if you don't have energy, what are you transitioning from? So if you talk about EVs, if you don't have grids, where are you going to charge your EVs? And if we spend 7 years structuring projects because we want to put in all the belts and braces to allow us to be able to invest in dollars, because unfortunately our countries are financing their projects in hard currency. Then, okay, you'll say, well, based on statistics, projects hardly go bust in Africa. That's because we put all the belts and braces, we overstructure, and it takes a long time. So you're not going to achieve energy transition if you take 7 years per project. You're not going to mobilize a lot of financing. In terms of the financial architecture, and this doesn't get talked about very much, it's completely wrong, because every time we finance our projects in dollars, we're relying on the savings of others, savings of outsiders to finance our infrastructure. So what we need to do is put more emphasis on domestic savings mobilization, because the people who are paying for your utilities are paying in local currency. And whenever the exchange rate, currency collapses against the dollar, then they find that those costs go up. And you can either absorb that at the consumer level or by the government. But most of these countries no longer have the fiscal space to be able to service all of these loans. And that's what we're finding now, that because countries are reaching their debt sustainability limits, it's actually difficult to channel investment into projects just because they can no longer borrow on international capital markets. So what do we need to do? I mean, how do we mobilize local savings? Trying to invest in Africa, what we see is that we have too many countries, there are too many currencies, and there aren't enough savings. These countries don't have sufficient external reserves. So what policies do we need to put in place to actually aggregate the savings that we have? And many of these countries suffer from capital flight. And there's an issue around how we manage global currencies, because as long as the US keeps printing money and, US interest rates have to go up because you unleash inflation and then emerging market currencies decline, then you find that the interest rates go up and those countries cannot invest long term because compound interest is going to kill their projects. So the issue of cost of capital that you were talking about, cost of capital and exchange rates are two sides of the same coin, and so there's a global conversation to be had about how we mobilize the capital. The guys sitting in New York, California, managing pensions, they're not interested in a Naira investment in Nigeria. They're not going to do that. The guys who are going to invest in Nigeria are the Nigerian pension funds. And even in terms of policy perception and policy certainty, if proximity makes a huge difference. And so what do we need to do? How do we create the macroeconomic conditions that encourage capital to stay in these countries? Because unfortunately, these countries run deficits. And they're also borrowing money to pay salaries. So you unleash inflation. They're not investing enough. Savings rates in Asia is probably closer to 30%, whereas in Africa, most of them are below 10%. Domestic resource mobilization, tax collection in many countries is like 5%, when the global average is closer to 20-something%. So these are the issues that we need to address. It's no point saying we have a pension pot of 5 trillion or however 100 trillion under management. Those monies are not relevant to us most of the time. They will come, but if locals are not investing, it's very difficult to get the outsiders to invest. And we can see the example from the Asian crisis in 1997. The lesson that came out of that was that there was capital markets reforms in many of these countries. The likes of Malaysia started issuing sukuks. They started financing more in local currency. Some of us remember all the power projects that went bust in Indonesia because of this currency mismatch. So for me, I think these are some of the nuances that do not get talked about. If we focus on the models and the global macro issues, but there are underlying issues.
Well, I thank you for segueing to that, because that's the next. We're going to turn to. That's the next one. And just to underscore the importance of it in these, and a lot of the climate models, they're projecting that 1 up to 2 trillion is going to be needed in emerging markets and developing economies to meet a net zero level by 2050. So if we take the broad conversation we were having about macroeconomics and those challenges, dropping it down to the EMDE region, to your point, these risk-averse assets are not interested in investing in that. So, some of the solutions that have been talked about are things like, well, we just need more blended finance with multi-development banks and that sort of thing. So, can you talk?
Explain to people what blended finance means.
So, blended finance means multi-development banks like the World Bank and other similar type of multi-development banks will put some be a lead or an investor that will help crowd in other investment from the private sector and absorb some of that risk. And the African Development Bank does this. Other types of development banks do that. Can you? So that's been sort of a topic that has been talked about. Can you talk about that and its application at scale relative to some of the other ideas that you brought up in terms of developing domestic savings and domestic investment, and what should we really be thinking about in terms of those solutions and how that's going to relate to your point, not just an energy transition, but energy development in the region?
So, I mean, I think for me, the idea of blended finance basically is that you take essentially donor funds and you blend it with commercial financing in order to get a lower cost of capital, and also sometimes to provide a first loss layer that will make investors more comfortable putting their money into a risky venture. But the problem is that the donor funding is not plentiful. You know, I mean, we all talk about the 100 billion a year for climate finance that has not materialized. So the Green Climate Fund that was established out of the whole Paris Agreement thing only has 10 billion, and they're going for another replenishment. So it shows you the scale. So this donor money is only tiny drop in the ocean. And it's really, I mean, we do projects in different countries that will only ever be demonstration projects. So you go and do an IPP. I'm doing an IPP in Chad right now, right? An independent power project, or do one in Burundi, right? And you stuff it full of blended finance and donor money just to make investors comfortable. And then you sign the deal. But it's not scalable because you're not going to be getting a lot of that blended finance coming in. So it's nice to have a demonstration effect, but to move on to the next stage, you need large programs. So for instance, one of the most successful programs we see on the continent is the South African renewable energy IPP program, which is managed to mobilize over $14 billion into that economy. But all of those deals are financed in rand. So you bring your money from wherever you're coming from, you're going to be investing in rand, you convert it because that market is deep enough, and you know there's fairly easy convertibility. You can bring your money in and take your money out. So you need to have those kind of conditions. And the projects that we're doing right now tends to be dominated by development finance institutions. The commercial investors are not there, either because they can't match the tenors that are required, or the risk-return profile does not interest them. So in order to have replicability, you have to be able to replicate, you need to be able to scale, and you need to be able to de-risk for local as well as international. But for the local investors, I think the threshold is a bit lower because they're not going to be asking for all these protections that you would if you were measuring your return, your IRR in dollars. You know, because your IRR in local currency may look attractive, but by the time you convert it to dollars, it doesn't look so great. So I think, I mean, in terms of addressing it, like we've talked about, there are issues around, being able to rely on combined savings, and the Francophone countries do that to a certain extent because they have like a regional central bank. But you know, the downside is their currency is linked to the euro, and they end up putting 50% of their external reserves in the French treasury, which has its own issues. But I mean, at this point in time, we're not talking about a single currency because politically that's going to be difficult. But the things like AFCFTA, that is the intra-Africa trade, is very important because you keep currency flows and money within the region, and you can also deploy that into investments. So there are more technical ways of addressing it, but it's perhaps not the subject for this conversation. Thank you.
Sort of follow up first on what Wale said. To level set our whole discussion here, I think what we've said is policymakers and, a lot of environmentalists, everybody thinks this is a walk in the park. How hard could this be? The world is rich. Sorry, as a developer, ex-developer in OECD countries, like financing deals that have gone all the way through permitting, which Chris, and environmental studies and contracting and engineering studies in countries like Canada and the US or France, it's bloody hard. It's bloody hard. Then you go, oh, sorry, now we go to Wale's world, and it goes from bloody hard to excruciatingly hard. And then we go to what Chris is going to talk about later is getting development money, the money of you might lose it all really easily with one bad regulatory decision. And then that ain't a walk in the park neither. So, yeah, whatever it is, it ain't a walk in the park, and we need to be on our A game, right?
That's another good segue. Thank you, Jeff. And the but just before we go there, I think that we've heard about the importance of policy certainty, but a lot of those policy conversations are in the OECD context. We also heard about the importance of just the fundamental mechanisms of economic development and the need to develop savings and investment in the developing regions of the world as another key component. And these are, unfortunately, topics that are probably not getting the attention they deserve relative to what we're talking about in terms of decarbonizing our global system. So now, thank you, Jeff, again. We're going to drop down to the lowest level and talk about what are some of the challenges related to financial markets and at the project level. So capital discipline is, Chris, you've published work on this. It's an issue that has not really been addressed in a lot of the climate models. And so could you talk a little bit about that the challenge that creates, or what the importance that's being missed by that absence, and also explain a little bit about what capital discipline is?
So I'll start with the modelling issue, right? So I want to just level set on how much capital we need. Most of these models lack the temporal granularity and the spatial granularity to actually pick up the nuance on project delivery or project operations. And so when we take some of these models and then we try to downscale them to local levels, we generally find that the capital cost goes up quite a lot, somewhere between 50 and 100%. So when you say 2 trillion extra, it may well be 5, right? So that, I'd say these numbers that we've been talking about are really lowballing the capital requirement. So that's the first thing.
What creates the multiple?
Well, so for example, they'll have one region for an entire country, and they won't do hourly matching of demand and supply. So they understate storage, they understate generation capacity, they understate transmission, they understate the changes in the cost of siting that come with going to different sites further from demand and so on. And it's a big deal, right? Now, that doesn't mean they're not useful, but we've got to be careful what we use them for. And one thing I would say is we've got to be, the numbers that come out from cost point of view, particularly capital numbers, take them with a grain of salt and treat them as lowball numbers. That's the first point. The second point, when we think about these models, essentially what they do is they simulate this world of idealistic investors who have perfect foresight of the future, perfect visibility across supply chains and up and down value chains, who cooperate harmoniously in pursuit of the net zero goal, right? I think we all understand that's not actually how the world works, that we have deep uncertainty, we have a lack of visibility, we don't cooperate, we compete.
Hey, Chris, and who are equally happy, absolutely equally happy to invest in Indonesia or Indiana. Oh, it's
Exactly.
like, yeah, whatever. It's an investment.
But the other thing they do is in response to a market signal, whether it's a carbon price or an IRA type production tax credit, assets mobilise instantaneously upon seeing that market, right? That market signal. But this is the reality where capital discipline comes, right? When I see a market signal, is the signal for me to now start conceiving a project. And from that point, I've got to define it, find a site, negotiate with site owners, do a feasibility study, look at a few different options, take it through permitting, do all the environmental impact studies. And when I've built enough confidence that this project is going to deliver the returns, then I'll want to settle my offtake contracts, lock into my site agreement, then I can get to FID. And that's when I'm going to come and talk to you and say, I'm prepared to put up 30%, please give me the 70% as debt. And so I've already spent typically, even let's take an OECD country. In Texas, that's going to take 3 years to 4 years to go from the conceiving to FID. In California, it's probably 5 years, maybe 6. And yeah, for a pretty easy solar project I'm talking about. If I start talking about CCS projects and I start talking about hydrogen projects, it gets longer again. And if I go to your part of the world, and you know, I built projects in Vietnam in the 90s, which is kind of like where you are today, and we spent an awful lot of money getting to FID. Now, you can finance anything, you can get anything to FID, but it requires an enormous transaction effort. It requires bespoke solutions, belts and braces, you know, central bank guarantees, all those sorts of things. That's not scalable, right? You need something that's much more systemic and able to be rolled out and repeated. So, you know, that's what I mean by capital discipline. There's this phase called development where no bank comes near it, but mostly the multilateral development banks don't do that either, right? They're looking for people to put their equity at risk to do that. And so when you think about putting that equity, if you're a company, in which I did this for my life, at the day of conception, you're agreeing to put equity at risk for something like 5 to 7 to 10 years before you're going to see any revenue. And there's a risk you'll never see revenue. So I spent, for example, $128 million developing a CCS project right up to FID, and I killed it. And that was the best decision I ever made, right? Because if we had done that project, it was in Australia when the carbon price was, you know, headed this way, and it was cancelled within 2 years. The carbon price was gone 2 years later. I also spent something like $4 million on a $100 million sugar project in Vietnam in the 90s, and we went ahead, we got FID and we built it. The worst decision I ever made, because I lost 2/3 of my wealth in one project, in a heartbeat, right? So, you know, that development capital is both high risk but crucial to getting in place investable projects that are not going to deliver losses.
So really for everyone, where does this capital come from? I mean, Vamsi, it's not JP Morgan. So policy driven, I assume?
Well, I mean, how did China get from where it was before to where it is today, where it has overcapacity in terms of developing infrastructure? It was trade, right? The world managed to channel trade flows in a way that benefited China. So how did UAE get from where it was 30, 40 years ago, or even less, come to Dubai like, 25 years ago, and it's totally different. It's trade. There's a commodity that the world wanted, and they decided to buy it from this region. So Africa has that opportunity, in my view, with green minerals, with, hydrogen and the potential and green products. If we get the policies in place that will drive trade flows through Africa, and those things are agreed at multilateral level, And so for me, we've been pushing for this, where for something like green products, demand aggregation. The rich world that is doing most of the polluting, they need to take a decision that in order to help us decarbonize, we're going to channel investment through Africa. That way we have hard currency offtake for green metals, green aluminum, green fertilizer, hard currency offtake in rich countries that will allow investment to flow. So it doesn't matter where you sit, in California, in Japan, you're going to get, and some countries are beginning to think about this. Germany, with its commitment to buy hydrogen from Africa, and there's H2 Global, which has been set up to make those purchases, right? We need more of them. We need the OECD countries to do that. And then market access. Instead of having IRA that channels all the investment into the US, we have to have market access and some incentives for people producing in Africa. We have the AGOA, Africa Growth and Opportunity Act that was designed to channel textiles made in Africa under the Clinton government into the US with certain dispensation. You can do that as well for green products so that we're not disadvantaged. We didn't cause the pollution, less than 3% from Africa. So we can come up with those kind of solutions. We're talking about changing the global financial architecture, because that architecture is skewed in a certain way right now that doesn't favor us. So it's possible, and it's out of self-interest. You guys need to decarbonize. So, you're not doing us any favors, right?
Slightly more complicated than that. I mean, the
Fine.
Middle East had those resources in the ground. It's not like these green hydrogen resources that, you've got to take a lot of risk to produce. And China had this incredible resource called cheap labour and a government coordination system that is, something we're not prepared to accept in the US or Australia or places like that, where they were able to really backstop the risk for manufacturing, which became their commodity.
Well, actually, I would beg to differ, because these resources that the Middle East has, they have them in other parts of the world as well. But there was a security agreement, security pact. The US went in and developed the resources in Saudi in exchange for providing security. And, and invested interest, because you had the OPEC crisis in the early 70s and you wanted to preserve the living standards of the Americans. That was a deliberate decision.
So I would like to, I think one really important point to pull out of this is when we're talking about capital and how capital moves and what drives it. Trade policy has historically been an important part of that, particularly when you can sell products into dollar or euro denominated type of markets. But we're currently in an environment where where countries are beginning to chafe at some of the trade flows that have been happening right at the time when we probably need to have more trade to get more capital flowing to where it has to go, particularly in the developing world. Jeff, you wanted, I think.
I just want to make
please,
one point on. So I think the couple of points that you made that I see as two sides of the same coin, which is you make the point about the currency risk being one of the bigger issues of sort of challenges that we need to resolve here. And you suggest one solution is obviously like increasing the depth of the domestic capital markets to be able to fund, right? The other side of the coin is, to your trade flows point, you can either say, I'm going to match the currency flow and the cost and the currency of whatever revenue on one side, or with your trade flows, you're saying if the dollar is the funding, and maybe I'm building out green minerals which are trading in a commodity exchange that's based in dollar, and then you can remove the currency hedge in a way that way as well, right? So I see, again, currency is the key thing, and then the second point you made around demand aggregation is also important, right? So again, definitionally in finance, diversification is one way of reducing risk, right? So is there a way to like create a vehicle that reduces the risk by combining a few different elements and packaging it? I know you raised the H2 Global. In Germany, they're trying to do that in stimulating hydrogen supply, so hydrogen demand, right? So I think all of those are interesting ideas, but at this point, like the market is like is still trying to figure out solutions. In my opinion, I still see like people dabbling in different ways of solving that, but I haven't seen anything specifically like come out that is a truly scalable solution, in my opinion.
Yeah, let me just give you a quick anecdote. I was in Japan recently, and there they have this experiment they're doing with their coal plants where they are blending green ammonia, 20% with the ammonia with the coal to reduce the emissions, right? And they placed a global tender for green ammonia from anywhere in the world. And the company that won that came out of the US because they have the IRA. And I was trying to introduce them to an African company that was doing the same thing. But price-wise, this company was not competitive. And to me, it's like, okay, it's a double whammy. We're losing twice because we're getting the impact of the pollution, but we're not being allowed to be part of the solution.
And I agree with you.
So,
I mean, you weren't the only one that lost, right? Australia, Middle East, Chile.
Well, we needed more.
Oh, it's next door. Well, so I think we've got a few minutes left. So I think this has been a fantastic discussion. I hope everyone doesn't walk away utterly depressed. The point of this is not to poke holes in the theory of the fact that we can decarbonize our global system. It's to really underscore or call out the risks that we have to address and deal with the realities, whether it's relates to policy certainty, whether it relates to the fact that we have to cooperate globally and be mindful of the fact that, as you pointed out, while most of the carbon stock in the atmosphere was developed by the OECD, and so we need to have a conversation about what the role is to ensure that the rest of the world has the chance to both develop economically and move to a decarbonized system in a way that's going to actually work for not only those countries, but actually work in a way that pulls in the capital from the global financial markets, because that's the engine of investment in the world. This is a conversation that we think is not getting nearly enough attention as it deserves. And I really want to express my appreciation for all of our panelists who gave I think, a very unvarnished and helpful view of what we need to be thinking about. Thank you very much.